Right. All right. There we go. Yeah, yeah, yeah. Another beautiful day. Another beautiful day. Um, Here's the thing. I know it's Thursday, but man, it feels like I don't know. It feels like an awesome beginning to the week, and the week is almost over with, which is kind of crazy. Um, I want to start out the day just definitely uh, thanking my team. I mean, oh my God. What my team has been doing behind the scenes has been truly amazing. Um, from the marketing side, CDP Media, if you guys have not gotten a chance to check those guys out, I'm telling you, you're missing out. You're missing out. Definitely to my assistant Jennifer. Oh my God, this young lady is a breath of fresh air. All of you guys who are calling in to our office, to our virtual office, you're greeted with warmth, virtually and over the phone. And quite honestly, it just doesn't get any better than that. But wait, um, super excited about where we're going as a firm. We've went from just being primarily East Coast. Now it's official, folks. It's official. We are, nationwide, right? Which is another superior level of excellence that I'm super proud of. We have, a few veterans working with us, which I'm very excited about. Those guys have just bring it up another level. They're just bringing it up another level. And the manner in which they are able to support and provide for all of our clients is truly amazing. It's truly amazing. But I would be remiss if I did not talk about the level of teamwork and family that we have within our firm. I mean, the way that we all work amongst each other, in just kind of like another level of leadership is very collaborative. Those of you guys who are our clients, understand when you're talking to me, you're talking to all of us, right? Because we're constantly sitting down and we're just trying to figure out what is the best route for you based upon your GPS results, right? And so if you haven't done so already, we put the link inside the chat box, definitely so that you can get access to your GPS and activate your GPS if you have not done so. So we'll be talking about that a little bit today during our brief time that we have together. But super excited for a lot of our clients. If you are new to the Laster Financial Consultants family, I want to say welcome. I want to say that you're loved. I want to say that we are all here to learn. We are all here to help. And we are all in this together, all right? We are all in this together. We are committed to you guys, and we are committed to taking the fear out of finances through education, and that's what tonight is all about. It's all about education, and what we want to cover this evening. What we really want to cover is we want to talk about the fractional banking system. Number one. Number two, we really want to dig into how do these transactions, day one, day two, day three, within the Flow to Grow program, how do they work and how do they best serve you? How do they best serve you? And what I challenge a lot of you guys to do is if you're listening right now, if you're listening in, and maybe you have a few questions. Maybe there's some concerns that you may have based upon your own financial picture. If you have questions, what I want to tell you is don't shy away from asking those questions. Don't shy away. And what we're also doing here is I want to make sure that we have here. I want to be able to see all of your questions that you guys are asking. Definitely go ahead and put them inside the chat box. Those of you guys who are listening to us via YouTube, welcome. Subscribe to that link. That's where a lot of our holistic trainers are going to be hosted in. Those of you guys who are listening by way of Facebook, welcome, welcome, welcome. Please like and subscribe to that page so you can click the notification bell so you'll be alerted at all of our new offerings. Now, let's get to it. A lot of what we're talking about and a lot of what we do inside of this Flow to Grow program, forgive me as I'm multitasking here. Yep, just making sure everything's good to go. As I'm navigating here. There we go. I want to talk about the fractional reserve system. I want to talk about what the banks are doing. And I want you to understand that our program is based upon what the banks are doing, right? Exactly what the banks are doing and how the banks are operating. Please remember, go ahead and let me know that you're here. Let me know what questions you have inside the chat box. Let's get after it, okay? In the fractional reserve system, right, it's very interesting to find out that, and obviously, we're providing resources. Here we go. We're providing resources. And what I really want you to understand about that fractional reserve system is that when you put in $1, into the bank, okay, from the fractional reserve system, the Federal Reserve credits that bank $10 for every $1 that you give the bank. $10 for every $1 that you put inside the bank. Okay? Now, because they get $10 for every $1, there's an agreement that's made to each of your banks, even before we start talking about our program that we're offering folks. Just understand this. 90%, or let's say $9 of every dollar that you put inside, $9, the bank is able to do whatever they want to. Loan it out to other people, purchase securities, invest in real estate. They're able to do that, okay? But that 10%, that small percentage, they are required to keep that inside of the bank. God forbid you want to zero out your account. That account needs to be liquid, okay? So here's the question for tonight. Here's the biggest question for tonight. The biggest question for tonight is, what do you think the banks are doing with that measly 10% that they have to make sure that it's liquid? What do you think they're doing? Right? Think it's just sitting there waiting for you to pull it out? Okay? And what you think about, banks also have a reputation of not losing money. Maybe they'll make the best decisions with their money, but they don't lose money. Banks don't carry debt, right? They put you in debt, but they don't carry debt. And I'm saying all this because I need your juices, your mental juices working right now, okay? That's the name of the game, right? So they have to leave that 10% in there. They are not interested, or very rarely, if at all, lose any money. So the question is, what are they doing with that 10% that you're just leaving inside your bank for a rainy day? What are they doing with that 10% that is just inside of the bank until the end of the month? What are they doing with it? And for that right there, I want to turn it over to our presentation that we have for you this evening. And obviously, we're presenting the Flow to Grow program. We're presenting the Flow to Grow program to you guys. Just so that you know, this is what's going on. This is the real deal, okay? So in this Flow to Grow program, the biggest thing is we're showing people how to index their money. We're showing people how to index their money, how to make sure that their money is growing when the stock market is growing. And when the stock market falls, they're not losing any money. They just didn't make any money. And it's principled just after how the banks are making their money. Now, not only are they making money when the banks are when the market is making the money, they're never losing money due to market downfall. So this is exactly what the banks are doing. And for those of you who are listening, what I really want you to do, so I really want you to go to the FDIC.gov website. I really want you to see that what we're telling you is true. Right? What we're telling you is true. And this is across the country. Like nationwide, people are opening their eyes and they're waking up. They're realizing that the banks are doing something very peculiar. It's legal, right? You sign that document every time you go to set up a new bank account. You give them your social security number, you give them access, and therefore that makes you a liability to the bank. Now, I want you to think about it. If you are a liability to the bank, if you're a liability to the bank, they now have an insurable interest on you. If you have a mortgage debt, you're now a liability to the bank that lent you the money, right? If you have a car loan, you're now a liability to that bank because they don't know if you're going to pay it back. They don't know if you're going to die. They don't know if you're going to run out of money, if you're going to lose your job, if you're going to get sick, if you're going to get ill. That's essentially what we're talking about. So for those of you who have questions about this program, tonight we're going to hit some of the hardest asked questions. And one of the first questions that's normally asked is, hey, why life insurance? Well, the bank's got about $21 billion in life insurance on you, on their top executives, on all of their employees. It's a smart move. It's a smart play, right? Over 21 billion, right? And that's way more than what is even that's 21 billion. That's the death benefit. The cash value was way higher than that. And I need you to understand that. And the question is, why life insurance? Why life insurance? There's a better growth rate, right? You can set this up to where there's zero market risk. You can set this up to where you're never taking losses and you're operating just like the banks. This is the most important part that I'm really trying to drive home. It's just like the banks. It's what the banks are doing. So why not you, right? So if the banks are setting their portfolio up for no loss, what's really important for those of you who are near retirement age or who are retired now or anybody who's ever thinking about retiring, what if you had a ground floor? What if there was a ground floor of money that you were always going to receive, that you will always have no matter what? There was a bottom floor, right? Okay, let's say your expenses are $4,000 a month. How cool would it be to know, no matter what, there's $4,000 a month coming to you every single month for the rest of your life as long as you're living? Oh, and by the way, when you pass away, that $4,000 a month is coming to your wife, no matter what. And then when she passes away, that $4,000 a month is coming to your kids. Now let's rewind that back. What if that $4,000 is coming every month, growing at a 1, a 3, or 5% cost of living increase, if you will, every single month? Folks, that's generational wealth. That's what you don't see on YouTube channel, Instagram, and TikTok. Are these people licensed? Do they really understand how this works? Are they doing this? Which brings me to number two. Number two is the way that this is set up, just like the banks do, it's all tax deferred growth. There's no taxes on this money because all the money that's going in here are post-tax dollars. So if there's no taxes, it's deferred tax growth and it's tax-free coming out, which brings me to the next point. The biggest deal about this, and I'm going to leave this up on the screen for a moment, all of the money that we're talking about is liquid and it's accessible, right? It's liquid. It's liquid, meaning that you don't need a credit check, a sob story, right? You don't need a cosigner. Hey, you just pick up the phone. Hey, I need that $4,000 in my account. Yeah, the account that's on file. Absolutely. And it's either coming same day or the very next day. That's what I'm talking about, right? I'm talking about having funds that are liquid and accessible. And look, this is not a knock to anybody who has money inside the stock market. It's not. Each financial product has its place. And a lot of times, people, they say, well, I can get my money out of my brokerage. You can. Well, what happens when you do? And I bring you back to number two. It's taxable. You get my point? It's taxable, right? So, and this is not a knock to anybody who has annuities. I was speaking to someone who was watching our Tuesday event, and she was talking about she has a 401k, she has annuities. She wouldn't tell me how much they were. And after I explained to her, I say, look, there's 5 risks in retirement that everybody has to face. Everybody has to face the market risk. It can go up and down. Everybody has to face the inflation risk, right? Cost of milk, eggs, juice, butter, water now. It goes up, 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 up. So what you're buying with $1 now is not what you're going to be able to buy in 10 years from now. So that's inflation. Number 3, everybody has tax risk, right? Because Uncle Sam is going to get their money. Everybody has healthcare risk, which is a large expense. It's the one thing that can truly explode anybody's retirement plan. And then number 5 is the longevity risk. How long can you handle these ups and downs and these adverse moments in life financially? What does that look like, right? So when you add that up and you're comparing other financial products, is it liquid and accessible? Is it tax deferred and tax free, right? But more important, this is a plan that everyone should have. This is a plan that everyone should have, right? It doesn't matter if you're a business owner. It doesn't matter if you are just but it doesn't matter if you're a breadwinner, husband or wife, partner or friend. Everyone should have this. Why? Because we're all going to die someday. Sorry, spoiler alert. You're not going to live forever, right? So if that's the deal, and if everybody should have this, why don't more people have this program? Why don't they have this plan? Ooh, got a better question for you. At the beginning of 2020, January 1st, 2020, what happened? It was a Secure Act, right? And when the Secure Act was put in place, the Secure Act basically endorsed, okay? The Secure Act basically endorsed the type of plan that I'm talking about. Why? Because the Secure Act recognized that people were not saving their money. People don't have a retirement saved up. And they got this report from IRS and Social Security. Guess what they said? They say, you know what? And those of you who have registered with SSA.gov, like I've been telling you to see how much you're going to receive inside Social Security, you get this letter from Social Security. What does Social Security say? It says Social Security, when it first started, they had 13 for every one beneficiary for Social Security, to fund Social Security. Now, they're down to 1.3 people paying into Social Security for every beneficiary. That's not good. So they created the Secure Act of 2020, and the Secure Act of 2020 basically endorsed index products, index life insurance products, and index annuities, right? To each his own. Depends on your financial goals. It depends on your plans. What do you need? What are you trying to get out of your money? What do you need to last you for the rest of your life? What does that look like? Do you have a ground floor? Or are you going to run out of money? Once again, get inside the chat box and activate your financial GPS so that you can know. Because this is a plan that everybody's supposed to have, right? Which brings me to number 5. Now, number 5 is simply this, and this is what really gets me excited, is that I can tell you now, Bill Gates, Oprah Winfrey, Jay-Z and Beyonce, Jeff Bezos, list goes on and on, LeBron James, they don't have IRAs. They don't have 401ks. They don't have Roth accounts. How do I know? IRS rule says that they make too much money, so they can't have any of those. So where are they stashing their money? Where are they stashing their money? And as we talk about where they're stashing their money, I'm also going to bring inside the conversation. And many of you guys, if you talk to me and if you've ever asked me who else is doing this, who else is flowing money, let's use Mr. Harbaugh, former coach of the 49ers. And what happened to him? He won a Super Bowl. He left, went to Michigan. And when he went to Michigan, get this, they thought this guy was a financial genius because he told them, hey, I like my contract. Everything's good. But I'm going to talk about how you're going to pay me. So I got a 10-year contract? Yeah. Okay, so listen. What I want for you guys to do is that 10-year contract, what I want you to do is I want you to flow it through my policy while I'm here. And each year, the little bit that you're supposed to give me out of that 10-year, just pay it to me out of the policy, not from you guys. Pay it to me out of the policy. Folks, he is now considered the highest paid college coach ever. Right? Now, let's dig a little bit deeper in this one because when he was able to do this, and they thought he was a financial genius, come to find out, many people in the NFL already know about this. Many people in the NFL are already flowing money. They already know about this plan. Why don't you? It's kind of like a plan for the elite, right? No, it's just for you. And just like Jennifer says, is this only for people who have money to spare? What if they're living from paycheck to paycheck? Listen. If you're spending every dime that you get, you're full. That's not me saying it. Many scholars will back me up on that one. You're supposed to save something. Now, minimum number is 10%. What we show people is 20%, right? Try to save 20% for 3 years. All the income you get. It'll change your life, right? If you are willing to save 20%, I can show you in 2 to 3 years you can be completely out of debt. I can show that to you. Hey, look, it's all about the numbers. It's all about the math, science, and the case study. It's all about the numbers, right? So definitely want to welcome you guys. Keep your comments coming inside the chat box. We're going to roll on through a lot of this. And I just want to highlight what we're truly talking about. We're talking about something called an index universal life. Now, if you're taking notes, write it down. Index universal life. You'll see a lot of information on index universal life. And I want to make this point right here. I want to make this point, and it cracks me up. Many folks have listened to professional phenomenons like Susie Orman or Dave Ramsey. I'll use those for example. They have a large following. Nothing against them, right? And I think Susie Orman, she has a financial background. Dave Ramsey does. He has a mortgage background, right? And they have something bad to say about, whole life insurance. I get it. It's very expensive. You got to take care of that for the rest of your life. And they got something bad to say, they said, well, just buy term, invest the rest. They hate universal life insurance. But the index, you'll notice if you Google it, or more importantly, YouTube it. Go on YouTube and put Dave Ramsey, Index Universal Life. Susie Orman, Index Universal Life. Pick your financial, Ken Fisher, Index Universal Life. They don't have anything bad to say about. These are the gurus. These are the ones that are talking on MSNBC, Fox News, CNN. This is who they call. They have nothing bad to say about Index Universal Life policies, right? And this policy is the chassis of the Flow to Grow program. It's the main pinnacle of the Flow to Grow program. There's a lot that we can do with this Index Universal Life policy, but the one thing I like to bring out is not only can we flow money through it, but this covers disability. This covers long-term care. This covers business and personal needs, all right? And it's based upon your monthly cash flow. That's it. It's just based on your cash flow. So here's a quick question. Do you have expenses? And every last one of you who listens should say yes. Now, do you have income to cover those expenses? Statistics says 92% of you should be saying yes right now. 92% of you should be saying yes. Okay. So if you have expenses, you have income, are you willing to save? Are you willing to save? Now, 100% of you should be saying yes, but, we can only work with those who are conscientious and they're ready to make a change. They're ready to do right for them and their family. They're ready to go ahead and realize some of the facts of life. And some of the facts of life is Hey, you didn't get in your situation overnight, and you're not going to get out of your situation overnight, right? Many of you understand that if you just research your favorite multimillionaire, billionaire even, you'll understand that things did not happen overnight. They had a steady, just keep going, keep going, keep going, keep building, keep building, keep building. And that's how this program is built. Now, I promise you, we were going to get into just the nuts and bolts of the numbers of how this program works. But I want to just go ahead and let's talk about day 1, day 2, and day 3. So to understand that, we want to talk about the power of indexing, right? Stock market goes up and down and all around, right? You can make gains, you can take losses, but more importantly, what if we talk about all your gains? What if we talk about all your gains, right? What if we talk about every dollar you have made since age 18? What if I told you that somebody's earning 3% or more on every dollar you have put inside the bank since age 18? What's your response to that? They didn't get it. They didn't just spend it. No, they stashed it and they saved it and they let it grow because of compound interest. That's how this works. That's how this works. Now, if we're talking about compound interest, and that makes sense, you'll understand that if you started this program 20 years ago and you put your money inside of the stock market, you'd be sitting short than $200,000. If you put it in the S&P 500 index, you'd be sitting north of $300,000. What am I saying? The index will outperform the market 97% of the time. It will outperform the market 97% of the time. Now, I'm not knocking the stock market because we use the stock market to help us outpace inflation, right? And for those of you who are starting the program, you need a little bit of time to outpace inflation. Okay, so keep all of that in perspective as we're going over this program, as we're talking about how this program works. What we really want to dig into is we want to talk about the true cash flow management program. What does that mean for you, right? What does that mean for all of you when I say the true cash flow management program? So I want you to imagine this. Day 1, you get paid money. That money can come from anywhere. That money can come from your salary, your second job. Some of you got a third job, your side hustle, your business, right? And there have been people that approached us and said, well, what about if I can save from my Social Security check? What if I can save from my monthly annuity check that I get? What if I can save from my pension? James, does that work? Absolutely. Well, what about the money I have inside my 401k or my IRA? What about that? Can I flow that? Absolutely. Is it liquid? That's the question. Is it liquid? Can you put it inside your bank for 1 to 3 days? If you can, and you can put it right back. How this program works. Can you flow money? Yes or no? And if you can say yes to that, it's possible. It's possible, right? Now, day 2, you take this money and you flow it through your index universal life policy. Remember? The same policy that nobody has anything bad to say about. Nobody has anything bad to say about an index universal life policy. True story, true story. So because of all of you guys, our firm is making sure that we're licensed, across the country. And I'm talking with the licensure coordinators of each of these states, and these licensure coordinators, they're telling me, we're talking about my, our Flow to Grow program, what we're doing, and my interests, and how I want to help people, and this is my heart after people, and they're saying, wow, you took, many people take the test, and they're only using 15 or 20% of what they learned from the test, but you and your team, you guys are using 80 or 90% of what you took the test for. You're applying what you learned. That's what's amazing to me. I'm sorry, I just get so excited about that. I'm so proud of the people that work. I'm so proud of my team. Totally good people. Oh, man. And the new hire, man, when you guys meet her, her name is Jessica. Oh, my God. She's Good stuff. Good stuff. I'm sorry. I'm spilling the beans too much. All right. So, anyways, day 2, you flow your money through your index universal life policy, right? But day 3, you take a loan from your policy using the policy loan provisions, and you take a loan from your policy. You take a loan from your policy. Now, this part right here, I'm going to explain 2 times and then a 3rd time when I start showing you policy illustrations. So here we go. Reason why you take a loan from a policy, and I want to ask you this question real quick. For the reason why you take a loan from a policy. For those of you who have a mortgage, is your mortgage tax or is the house tax or is the property tax? Which one is it? Mortgage or property? Can somebody put that in the chat box? Who's listening? Who's listening? I want to see who's paying attention. Which one is tax? Anybody? Anybody? Mortgage? Is the mortgage tax or is the loan tax? I mean, or is the property tax? Anybody? There we go. There we go. There we go. The property. Good job, Emerson. I appreciate you, bro. The property is tax. Good job, Charles. The property is tax, not the loan. So if the loan is not taxed, I want you to understand something. The only way to have tax-free income is if it's issued to you by a debt instrument. If it's issued to you by a debt instrument, right? If you get a loan, that loan can't be taxed. So what about the system of taking perpetual loans from your policy? That's the way we do it. We do that so there's no tax. Okay? Right? Why do we take a loan? What's the second reason why we take a loan? Because we never want to disturb interest. You don't want to disturb interest, right? I'm about to explain it a second time, but I'm going to show you something else. So that's the reason why we take a loan. And for some of you smart Alex, here we go. And I mean that in the lightest and funnest way. No offense to anybody. Okay. I know some of you who have friends or spouses or people who may have some kind of view about a program, said, oh my God, I think it's too good to be true. Right? Well, if you have a loan, don't you have to pay the loan back? Folks, there's a death benefit. The death benefit is astronomically large. So the death benefit, the loan is not due until you die, and the loan is paid off by your death benefit, not by you while you're still living. That's why this works. That's why this makes sense. That's why so many people across the country are jumping on board, right? So as we talk about that, okay, let's recap. Day 1, you get paid. Money can come from anywhere. Day 2, and let's say you're a business owner, you're flowing $25,000, you got $25,000 a month. Maybe that's an expense you're trying to replace. $25,000 coming in. First and foremost, you start earning almost 7% on that amount right there, right? Okay. And how do you earn it? It's by the S&P 500. Okay. But here's one of my favorite parts that I like to point out. Those of you guys who know me, I love this part. Here we go. Your policy has a cap. That means the insurance company has to make you your money before they can make them their money. They got to make you money before they make money. So you're a doggone priority, right? What does the banks do to you? The banks make the money and then they pay you about 0.2, 0.4, 0.5%. Or if you lock your money up in a CD or a money market account for a year, they may give you 1%. You've been there for a while, you lock your money up for longer, maybe you'll get 2%. But they're making 7% or more. Well, you can be the bank. That's what I'm trying to get. I want you to be your own bank. Stop going into debt to other people. You be your own bank and report your own payments to yourself and increase your own credit score. Now, we got a debt detox class coming up. I just want to drop those beans real quick. We got a debt detox class coming up, and I'm going to show you guys how to clean up your credit for scot-free, right? For scot-free, when you register for this class, I'm going to show you guys how to do a debt detox. And I think you should do it quarterly, in my opinion. But it's called a debt detox. I'm going to walk you through step by step. I'm going to do it live for all of you guys. We'll send that out. If you want more information, you got to like the page. You got to stay plugged in because we want to see you off well. We really, really want to help you guys. So anyways, the next thing is you're not going to lose any money. That's a statement that's backed by the state, enforced by the federal government. You're not going to lose any money due to market downfalls because, folks, it is insurance. Here's my best part. Here's my favorite part. This is my favorite part. All right. I get really excited about this. Here we go. My favorite part is the fact that you have a large death benefit. Our average client has about a $3 million death benefit. $3 million. And if you go to lasterfinancial.com, you read my bio, you'll know that my mom has been in geriatrics going on 30 years now. And I've seen the good, the bad, and the ugly when it's time to come care for our elderly in our senior citizen population. And what I like about this program is that the way that it's built, 50% of your death benefit is your long-term care. It's your disability. For all you truck drivers out there, right? God forbid you get in an accident, you can't work for 3 months. This is the program for you. For all you contractors who are working in construction right now, this program is for you. For all of you who are cosmetologists and you work with your hands, if you're a dentist and you work with your hands, if you're in the medical industry and you work with your hands, this program's for you. If you're a school teacher, this program is for you. If you are a business owner, I can't say, if you are a business owner, this program is for you. Because everybody needs that level of coverage. Because Social Security requires that you're disabled for at least 12 months. And then they'll prorate whatever you have going on. If you have like an AFLAC, you can't get AFLAC and Social Security disability at the same time. You got to choose one, right? Social Security is 66%. AFLAC is made 40% of your income. What are you going to do? You were living on one income, and now your income is either 66% or 40%. What are you going to do? That's why this program works for you. And it's not reportable to the IRS because it's coming from an insurance company. I love this part because of the death benefit. Okay. Moving right along. The whole idea of this program is on an 80-20 basis, right? We want you to start saving 80% at least for 3 years. Retain 20%, but then take a loan, as we talked before, and put it inside of your checking account on day 3. Day 3 is a marvelous day. Okay. Now, why you want to do this? Now, I want to dig into this part right here. What you guys see on on your screen. Okay. It's called the principle of differential. Okay. I call it arbitrage. Other people call it differential. Let's explain. Now you got 2 buckets of money going. You got your reserve account or your savings account, the money that you're going to leave behind. And then you have your loan account, the money that you're loaning out of your policy. Your reserve side is earning 7%. Your loan side is earning 7%. Your savings side, your reserve side is getting 7%. But on your loan side, they're charging about 3.5% interest. There's a 3.5% or more in interest left over that you get to keep. That's called arbitrage. You're earning a differential on something you didn't really do anything except but flow your money. And that is the basis of why this program works, right? So here, let me ask you a question. Now that you know what you know, right? Let's say you save $20,000 a year over the course of 10 years. You save $200,000 times 7%. Impressive. Right? Was that $14,000? That's pretty cool. Or you get paid 3% on all the money you took out. So let's say you were flowing $100,000 a year. You saved $20,000 inside your reserve account. Is $80,000 here. 80,000 times 10 is $800,000. You do the math. 3% on that. All right. Bonus points for anybody who can tell me how much did you earn on 3% on $800,000. Anybody? Can anybody help me out there? Somebody pull out a calculator real quick. My man Charles. right? Jennifer, anybody, Emerson, somebody, come on, who's listening, right? Uh, anybody gonna put that in the chat? Come on. $800,000 times 3%. Anybody? $24,000. There you go, $24,000. All right, what's that? Giraffe? Thank you. Good job. See, somebody passed third grade math or above because you're a good job. $24,000, right? Now, as you're doing the $24,000, and good job, guys. Thank you guys for paying attention, right? So if you're thinking about $200,000 and you earn $14,000, what, 7%, $14,000 versus $24,000, right? What is mainstream finance companies telling you to do? To do it the traditional way, to put your money inside of an account and slowly grow interest. Slowly grow interest, right? Well, here's the difference. The difference is that there's compound interest that's growing here. There's compound interest that's growing from your loan account. So every time you're pulling out money from your account, every time you're flowing money, every time you're taking that loan, you're earning money. You're earning money, right? I like to tell my clients and say, hey, look, you turn on, Fox Finance, MSNBC Finance, whatever you want to do, Yahoo Finance, and you look at the S&P 500, and if you see a green arrow and it's pointing up, you just made yourself some money. Everybody say money, right? Right? But if you see a red arrow and it's going down, well, you didn't lose any money. You just didn't make any money. It's okay. This is what I show you statistically. These accounts are earning 7% interest, and that's since 1926. That's history, right? So you have two buckets of money that's growing. You got the 7% over here, the 3% arbitrage right here. You add it together, man. Now we're talking, okay? So as we're talking about this, I want to really just dig in. And I want to show you this. I just really want you to understand. As you're doing this program, you're still going to take your money and spend it on what you normally spend it on. Pay your mortgage, pay your rent, pay the babysitter, pay the doctor, pay your utilities, right? Pay your credit cards, do all of that. But before you do, what do you need to do? Can somebody put in the chat box? What do you need to do, right? You got to grow, right? You got to grow. What do you do? The more you flow, the more you grow, right? So what I really wanted to do tonight is I wanted to get through that because I want to share with you some real life examples of some of our clients and what's going on there. And I want to share my screen real quick. And first thing I want to do is I want to check and see. There we go. The first thing I want to do is I want to talk about how this program works and what it looks like for an ordinary person. Okay, I'm gonna teach you how to read this to read the sheet. And those of you guys who are interested in having this done for you and your household will gladly do it. So how the program works is, you got year 1 through 7. That's your corridor period, right? So let's say 35-year-olds flowing $100,000, okay? And as they're flowing $100,000, they're going to take a loan out for $80,000. This obviously is over the course of a year, right? It doesn't have to be a one shot. Just be continuously through the year, right? And they're going to leave $20,000. They're going to leave $20,000 inside of their policy, right? All right. So there's $20,000 plus the cash value at the end of the year, which is $10,949. So that means you have $30,000 built up inside of your policy. The deal is your corridor period is 7 years. So you're doing that for 7 years, right? Now, on year 8 is a special year, right? Because on year 8, you get to do 100% flow. So 100% of the money that you put inside of your policy, 100% you get to take out. 100% in, 100% out. So for years 1 through 7, we're maintaining that 20% base. Okay, we're maintaining a 20% base, making sure we leave 20% behind for savings. All right. Now, what about that 80%? It's a flexible premium product, people. So what if 1 year you don't have the 80% to put in there? You don't have to put all 80% in there. It helps. You remember that 3% arbitrage you get earned, but what if you don't have it? Okay, you don't have it. But continue to save, right? So let's say you do your savings, then what happens in year 8? 100% in, 100% out, 100% in, 100% out, right? I want to stop long enough to say the total out of pocket in this illustration, if you can see the screen, is $140,000. $140,000. Okay? Now, in this example, this person just continued to do 100% in, 100% out, 100% in, 100% out, 100% in, 100% out, right? And now let's get to retirement. That $36,000, I just put that there to represent hypothetical Social Security. But how many of you guys like these odds? You flow your Social Security check, you put in a $36,000, you pull out $100,000, right? And how long do you get to do that? Well, you get to do that for the rest of your life. Now, we can continue on after here, but what I really want you to pay attention to is one, you can continue going if you want to. There's enough money there, okay? Number two, and by the way, I like age 80. You're a millionaire, right? Age 80, you're a millionaire just because you flowed money, right? But here's the biggest thing. Age 75, you got a $4.9 million death benefit, $9 million death benefit. All right, here's a quiz. What does that death benefit mean? 50% of what equals your what? Anybody? Somebody type it in. If you were paying attention, I want to see who was paying attention. I'm checking right now. 50% of that death benefit is your what? Anybody? 50% of that paycheck is your what? Anybody? 50% of that paycheck is your long-term care. There you go. Right? So, and I like Jennifer's question. She just says, so if I put my paycheck into this policy, then pull it out what I need to spend on my expenses, what's the catch? That seems easy. Here's the catch. The catch is don't touch your savings. Don't touch your savings. It requires discipline. That's the catch. The catch is you have to learn one behavior. That's the catch. And that catch is flow your money before you spend it. That's the catch. Right? Now, we have some clients that are very disciplined, right? Down to the T. And we have some people that don't forget it. Classic story is I was working with a client at the beginning of the year in January. She came to one of our live events. Was it January? No, I'll say January. Okay, it was at the beginning of the year. And we're doing an annual review. And she goes, oh, James, she goes, I saw your commercial or something, and I'm sorry, I haven't been flowing money. Let's just talk about it. You know, what's my cash value? I said, well, you only flowed money for 5 months, and your cash value is $66,000. She just put her head down. She goes, oh, my goodness. I said, well, what's wrong? That $66,000 in 5 months. I said, that's good. She goes, what if I flowed for the full year? Imagine what my account would be then, right? So as we're talking about that death benefit, it's not just about the cash value. And I like what Nefty says here. He says that's disability. 50% of your death benefit, that's your disability. 50% of your death benefit is your long-term care. Folks, we have the remedy for Social Security. I don't care about Social Security. Social Security. Get yourself a flow policy. Get a flow policy for your parents. Get a flow policy for your grandparents if they're under age 82, right? Get a flow policy for your kids. How many kids are coming up with some type of autism or disability or so forth? Get it for them while they're young. Flow money through their account. How many people are putting their kids as authorized users on their credit cards at age 16 so they have an 800 credit score when they go to college and they buy them a brand new house and a new car? We're going to talk about in that debt detox class, so get ready, guys. Okay, so here's the deal. That's just one of the illustrations that I wanted to show you. Here, let me switch it up. This is one of the real reasons why I love doing this. These types of illustrations. I want to explain them to you guys. I want you to think about the qualifications to own a home. Okay, I want you to think about what it takes for you to own a home. Right? Because if you're trying to get a mortgage, there's a debt to income ratio, right? And from that debt to income ratio, a mortgage lender will want to know, can you afford to make these house payments? Okay. What are all of your obligations? Let's switch the word from obligation to expenses. What are your expenses? Right? Now, your income is a driving factor, but your expenses can't be more than 43%, or they're not going to give you the house. Now, many of you are saying, okay, my expenses are not 43%. We actually do pretty good inside my household and we keep it down, right? So I want to show you what we call an expense flow, right? The expense flow says, same deal, 100,000 in, pull 80,000 out, leave 20,000 behind, right? A little higher cash value right here, okay? But when, and then the 7-year incubation period, okay? Leave money in, total 140,000 out of pocket, okay? Now, what happens here on the 11th year? It's 40%, that's about the expenses, right? Okay. And the other thing that if you notice, it's increasing at a 5% cost of living increase. So if you work this program, if you stay with it long enough, it's giving you your return. Now, here's the big thing. I don't know if any of you noticed it. There's no more money going into the policy. There's no more money going into the policy, right? So this is the term, whole life, combined, the best of both worlds. There's no money going inside the policy, but because you did a good job for 10 years, it's paying you for the rest of your doggone life. This is exciting. Now you see why I wake up in the morning. Many of you are stressing right now, living paycheck to paycheck. You're trying to figure out how you're going to make it. You're trying to figure out how you're going to do it. You're trying to figure out, what are you going to do? Are you going to put your kids through college? Or are you going to sacrifice your retirement? You're trying to figure out, when are you going to pay off this house bill? Some of you have a spouse that's not doing well health-wise. And you're trying to figure out how to put those pieces together. And what I'm showing you is with these case designs that we are providing people, we're just activating your GPS, and we're talking about, okay, what's your situation? Who's in your family? Good. What's your income? Are you able to save from your income? Good. All right. So tell me about your expenses. What does that look like? Gotcha. What's your game plan for the future? What are your goals that you're trying to reach? Are you trying to save for something? Are you trying to replace expenses? Maybe your mortgage, you want to replace that? You're trying to pay off debt? Well, what are we doing? Are you ready to retire and have your income replaced? And when I say retire and have your income replaced, that means that deadbeat job that you don't like, that occupation that you're doing that you don't like, that relationship that you're in and you're trying to figure a way out of it. It's not good for you. It's not healthy. What's your focus? What's your target? What are your financial goals? 99% of the problems people have here on earth can be solved financially. What's your issue? What's your fear? What's your concern? Where does that lead you? Right? Quite possibly, and many people who have come to us will tell you that this program was suffice to start mitigating those problems and handling those problems. So this is why I get excited when I wake up in the morning. This is why I'm excited when you click the button, you make an appointment, and this is why I'm head over heels for you. Because I already love you. And I already want to see you successful. I want to see you win, because when you win, I feel like I won. My whole team feels like we all won just because you won. So I want to leave you with this point right here. Whether you're saving for something, whether you're trying to figure out maybe paying off credit card debt, you want to pay off the house, your daughter's getting married, You want to buy a new investment property. Oh my goodness. Or you just want your expenses replaced. You want to go to work because you want to, not because you have to. You want to be able to spend more time with your kids. Be like James and go to the beach, right? You want to make sure that your affairs are in order and they're taken care of, so you can really begin to see what life has in store for you. And for that, I say, click the link, activate your financial GPS, and get yourself a flow number. Know your flow number. If you know your flow number, you're ready to roll. Okay. So I want to thank all of you guys for being a part of tonight's event. Look, before I get out of here, oh my God, we got a lineup for you guys. We're going to be online more often because there's so much that we want to share with you. We're looking for it with Marketing Mondays. We're setting that up with CDP Media. Man, for those of you who are entrepreneurs, you're business owners, if you're in real estate and you want to get some marketing tips, tricks, and loopholes, Marketing Mondays is going where you're going to want to be. We're going to, on Tuesdays, we're going to be doing Tax Tuesdays, right? Tax Tuesdays. Definitely setting up current event Wednesdays. We want to talk about what's going on. How are you guys doing? Love to hear from you guys. Thursday will be our main events night. We're going to be digging more inside of our Flow to Grow program. Fridays, Flow Fridays. I'm excited about Flow Fridays because Flow Fridays, we are lining up the entrepreneurs of the week. I spoke to one who earlier today. She's the first one that comes to mind. She sells, well, not that she sells, but yeah, she does. She has this wonderful product for those of you guys who are really health conscious. She does a really great job of explaining all of these items. I love that part right there. And then on Sundays, we got a special treat for entrepreneurs and business owners on Sunday afternoons. So this is great. This is good. This is well. I'm excited. I hope you are excited. And look, one last thing. Share this with a friend. If you haven't done so now, go ahead and like the channel. Go ahead and subscribe. Hit the like button. We won't spam you. We won't sell your information. But what we want to do is we want to start one person at a time, reaching one community at a time, because we no longer have to live in fear. When the word gets out about this program, we don't have to live in fear. If all the wealthy and the elite are running this program, if they're doing this program, why not you? It's not a get rich quick scheme. It's a get rich for sure. So I'm James Laster, Master Financial Planner, CEO of Laster Financial Consultants, with an amazing team of individuals that are like-minded and they love bigger than I do. They love bigger than I do, and that's what it's all about. I know some of you could be thinking in the back of your mind, okay, what did they get out of it? Seeing you succeed is more than we can even bargain for. So I'm going to leave you with that tonight. You guys take care. God bless. Be well. And I'll be checking you guys out tomorrow, Flow Friday. And if you don't catch Flow Friday, I'll see you next week. Same bat time, same bat place. Be well, you guys. Take care.